Okay, maybe before we even talk about 2% of discount, there are two types of discount that you need to know. What we call trade discount and settlement, or we call it cash, or we also can call it prompt payment discount. So for trade discount, what is trade discount? The purpose of trade discount is to encourage bulk buying. A very common example is whenever you go to supermarket, okay, not necessarily supermarket, you go to shopping malls, especially during New Year when you want to buy new clothes, you want to shop for new clothes, whatever. You realize that they always say, oh, buy 3, free 1. Or buy 2, and then the second one, I give you 70% discount or 50% discount. All this type of discount is what we call trade discount. Is to encourage bulk buying, to buy a lot. So for trade discount, there is no double entry. We will record using what we call the net price. What does it mean by net price? So, before we continue, some other terminologies that you need to know. So we have, first, we have list price. List price, like the name suggests, is the price that is stated, that is listed in the mall. So when you go to the mall, they will have a price tag. Whatever price that is shown, that is what we call the list price. Minus trade discount, this is what I call the net price. So when we say trade discount, there's no double entry because we straight away record at the amount after I minus the trade discount. I don't bother recording the original price in my accounts. So therefore, there's no double entry required for trade discount. Remember that. So this is for trade discount. What about settlement discount? What is the purpose of this? Or cash discount or prompt payment? Like name suggests, prompt payment is to encourage fast payment. So how normally people do things in business? When you buy or sell things, people don't pay immediately. It's normal in doing business. But although you allow people to pay you later, do you want them to, of course, pay you as early as possible? So how do you encourage people to pay you fast? By offering this, what we call settlement or cash or prompt payment discount. All right. So if you are talking about this, there are two perspectives. Either you are receiving the discount or you are allowing the discount. Under what situation do you receive a discount? When it's a purchase transaction, when you are buying something, then you receive a discount. So the opposite, when do we allow a discount? When you are selling something, you allow some discount to your customers. All right. So Let's look at receiving discount first. When I receive a discount, what will happen? First, number one, the amount that you owe will decrease, which is your payable. So therefore, I will debit payables to reduce my liability. And what do? I credit to what we call discount receipt account. This account is an income. And income is credit. So therefore, to record an increase in income, I credit it. And I record this. When do I record it? I will record this transaction when I make the payment. Of course, when you make the payment, then only you know whether you get the discount or not. So when you make the payment and you receive the discount, debit payables, reduce your liability, credit discount received, which is an income. So this is a simple one. Let's look at the complicated one. Allowing your discount. So I believe you guys have seen the word accounting standards. So accounting standards is basically like the Bible of financial accounting. It provides guidance to tell you for every particular transaction, how should you record it. So based on this accounting standard called IFRS 15, so these accounting standards you are not going to learn in detail yet. It's a very complicated standard, so I also don't want to go too much in detail. But at least for your level, what you need to realize that for the case of allowing discount, I need to, or the company needs to mix an expectation of whether the customer will pay early or not. You're going to make an expectation on whether your customer will pay early or not. So I hope you guys realize that when you're receiving the discount, you are the one who controls when you pay. You are the one who makes the payment, so you are the one who controls when you pay. But when you are the seller, can you actually control when did the customer make the payment? You can't. So since you can't control when the customer make the payment, you also won't know whether the customer will take the discount or not. Because by right, they only get the discount if they pay early. So therefore, what we need to do is to make our own expectation. So therefore, there are two scenarios that branches out from here. One is, yes, you expect your customer to pay early. Remember the double entry, how we record sales? So when the sales happen, what's the double entry again? Debit receivables, credit sales. But the only difference is we are going to record this transaction by taking list price minus any trade discount, and I will straight away minus my cash discount immediately when I record the transaction. So I repeat, I don't purposely record a separate discount allowed account, But when I record my sales at the very beginning, I will minus the cash discount out from the amount already. All right, so this is the first scenario. Second scenario, what if you don't expect that they will pay early? You think they actually will pay late. So in this case, when the sales happen, you just record as usual. But in this case, you don't minus your cash discount. You don't minus your cash discount. So double entry is still the same, but the amount recorded will be different.